Right now, as you are watching this video, the clock is ticking. April 15th, 2026 is just days away. And for millions of senior homeowners across the United States, this tax deadline is not just a date on the calendar. It is a moment that could change everything, including whether or not you get to keep the home you spent decades paying for. I know that sounds alarming, and honestly, it should. Because what is happening right now with IRS tax debt and senior homeowners in America is one of the most underreported financial stories of the year, and nobody is talking about it the way they should be. So today, we are going to break it all down, the real facts, the real process, the real dangers, and more importantly, the real solutions. Because if you are 65 or older, or if you have a parent or grandparent who owns a home, this information could literally save that home. Let's start with the numbers, because the numbers tell a story that is very hard to ignore. According to the IRS's own April 2026 warnings, the late filing penalty for unpaid taxes starts at 5% of whatever you owe, and that is for every single month your return is late. Every single month. That penalty climbs all the way to a maximum of 25% of your unpaid balance. And if your return is more than 60 days late, the IRS hits you with an additional minimum penalty of at least $525, or 100% of the tax you owe, whichever amount is smaller. Now here is where seniors are getting hurt the worst. On top of the failure to file penalty, the IRS also charges a completely separate failure to pay penalty. That one runs at 0.5% per month. And when both penalties apply at the same time, which they very often do, they stack on top of each other. Financial analysts are reporting that combined, these two penalties can push your total liability to as much as 47.5% above your original tax bill. And then there is interest. For 2026, the IRS is charging interest at a rate of approximately 6 to 7% annually on unpaid taxes. And this interest compounds daily, not weekly, not monthly, daily. Every single day the debt sits there unpaid, it grows. Now imagine you are a retired senior living on Social Security and a modest pension. Your fixed income barely covers your groceries, your medications, and your utility bills. And suddenly the IRS is telling you that a tax debt you thought was manageable has exploded because of penalties you didn't fully understand and interest you didn't see coming. This is not a hypothetical situation. This is the reality that tens of thousands of senior homeowners are facing right now. And the question that everybody is asking, the question that is driving millions of searches online right now, is this: can the IRS actually take your home? The answer is yes. Legally, they can. But the way it actually works, the process behind it, and what you can do to stop it, that is the part of the story that most people don't know. Let's walk through exactly how the IRS collection process works, step by step. Because understanding this process is the first step to protecting yourself. It begins the moment you file a tax return with a balance due and don't pay it, or the moment the IRS assesses additional taxes on your account. At that point, you receive what is called a notice and demand for payment. This is your first official warning. If you pay the balance or set up an approved payment arrangement at this stage, the process stops right here. The problem is, many seniors either ignore this notice, don't understand it, or genuinely cannot afford to respond to it. Then come the follow-up notices. The IRS sends escalating reminder letters, first CP501, then CP503, then CP504. The Taxpayer Advocate Service has confirmed that more IRS notices are being sent in 2026 than in previous years, specifically targeting taxpayers with outstanding balances. The CP504 is particularly serious. It warns that the IRS may begin levying your state tax refund and will pursue additional collection actions. If the debt still goes unpaid after all of this, the IRS moves to step 3, the federal tax lien. This is the moment things get very real for homeowners. A federal tax lien is the government's legal claim against all of your property, your real estate, your personal property, your financial assets, all of it. The lien attaches to everything you own at the moment it is filed, and it also attaches to everything you acquire in the future, for as long as the lien remains in place. The IRS then files a public document called the Notice of Federal Tax Lien. This alerts creditors, including your mortgage company, your bank, and anyone else with a financial interest in your property, that the federal government now has a legal claim that takes priority over theirs. And this lien once it is filed, has immediate and serious consequences even before the IRS takes a single dollar from your account. First, it becomes almost impossible to refinance your mortgage. Second, qualifying for any new credit becomes extremely difficult. Third, if you try to sell your home, the lien must be satisfied from the sale proceeds before you see a single dollar. And fourth, the lien is a matter of public record, which means anyone can look it up. Now here is the critical question. Can the IRS actually seize and sell your primary residence, the home you live in? The answer is yes, but it comes with very important legal guardrails that you need to understand. Unlike bank accounts or vehicles, the IRS cannot simply walk up and take your primary residence. Before seizing someone's primary home, the IRS must obtain approval from a federal district court judge. The agency has to go to court, present its case, demonstrate that there is a valid tax debt, show that all other reasonable collection methods have been exhausted, and convince a federal judge that seizing the home is the appropriate response. That is a very high bar, and it means that primary residence seizures are extremely rare. Legal experts and IRS data consistently confirm that home seizures are genuinely last resort actions. The IRS prefers liquid assets like bank accounts and wages because those are faster and easier to collect. The agency will almost always try to garnish your bank account or apply a levy to your paycheck before it even considers going after your house. But, and this is a very important but, there is another legal path the IRS can take. Under a specific section of the Internal Revenue Code, the IRS can file what is called a civil foreclosure lawsuit to enforce its tax lien and force the sale of a home. This applies to primary residences. The process involves filing a lawsuit in federal court, notifying all relevant parties, including your mortgage lender, and if the court rules in the IRS's favor, the home is sold at public auction. Your mortgage lender and any other creditors with liens senior to the IRS get paid first from the auction proceeds. Then the IRS gets its portion for taxes, penalties, and costs. If anything is left over after all of that, the homeowner receives the remainder. For seniors with significant equity in their homes, people who have been paying their mortgage for 30 years and now own a substantial portion of their property outright, this is where the risk becomes very real. The IRS is far more likely to pursue a home with significant equity than one that is heavily mortgaged. And there is one more thing that catches many senior homeowners completely off guard: the situation involving jointly owned property. Here is a scenario that is playing out for real families right now. A senior couple owns their home together as joint tenants. Only one spouse has an IRS tax debt. Can the IRS pursue the home? The answer is yes. The federal tax lien attaches to the indebted taxpayer's interest in the jointly owned property. And under a legal framework established by the Supreme Court, the IRS can force the sale of jointly owned property, with the non-indebted spouse receiving compensation from the sale proceeds. That means a spouse who owes nothing, who did nothing wrong, who paid every bill on time, could see their home sold because of a debt owed by their partner. For senior couples who have lived in their homes for decades, who built their entire lives around that property, this is devastating. And it is completely 100% legal. Now let's talk about what makes seniors specifically vulnerable in 2026, because this is not just a general tax story. There are very specific reasons why the 65 and older population is disproportionately at risk right now. First, multiple income streams create tax complexity that many seniors are simply not prepared for. When you are working a single job, your employer withholds your taxes and everything is relatively straightforward. But in retirement, you are often pulling income from multiple sources simultaneously: Social Security, a pension, required minimum distributions from your IRA or 401k, perhaps some investment income or rental income. Each of these sources has its own tax treatment, its own reporting requirements, and its own withholding rules. It is very easy to underpay, especially if your income situation has changed recently. Second, and this is something we see every single year, many seniors genuinely believe they no longer have to file taxes once they retire. This is false. If your income exceeds the IRS filing thresholds, you are required to file a return regardless of your age. And those thresholds change, which means someone who was below the threshold one year might be above it the next without even realizing it. Third, required minimum distributions are catching people off guard in 2026. If you are 73 or older, you are required to take minimum distributions from your traditional IRA and most other retirement accounts. These distributions count as taxable income. If you did not properly account for them in your tax planning, or if you miscalculated the required amount, you could be facing unexpected tax liability on top of the penalty for taking too little. Fourth, the new provisions that went into effect for the 2026 filing season are genuinely confusing for many seniors. Here is what is real. Seniors age 65 and older can now claim an additional $6,000 deduction per person, or $12,000 if married filing jointly and both spouses qualify. This is a major benefit, but it phases out for individuals earning above $75,000 in modified adjusted gross income and for joint filers above $150,000. If you miscalculate your eligibility for this deduction and overclaim it, the IRS can come back with a bill for the difference, plus interest and penalties. The IRS has also confirmed that enforcement activity is expected to increase in 2026, particularly targeting higher income earners and individuals claiming the new deductions introduced this year. More notices are being sent, more audits are being triggered, and more collection actions are being initiated against taxpayers with outstanding balances. Now let's talk about what the IRS can do specifically to seniors, beyond filing liens against their homes. The IRS has the legal authority to garnish up to 15% of your Social Security benefits to satisfy an unpaid federal tax debt. This is called a federal benefit offset. And unlike some other collection actions, it can happen without the IRS going to court. You will receive a notice before the offset occurs, but once that process begins, 15 cents out of every dollar of your Social Security payment goes directly to the IRS. For seniors who are already living at or near the poverty line on their Social Security income, losing 15% of that monthly payment is not just financially painful. It can mean choosing between medication and food. The IRS can also levy your bank accounts. If the IRS sends a levy notice to your bank, the bank is required to hold the funds in your account for 21 days and then send them to the IRS, unless you have worked out a resolution during that window. And if your retirement accounts, your IRA, your 401k, your pension, are held at institutions that receive the levy notice, those are subject to collection as well. Many people don't realize their retirement accounts can be reached by the IRS. But this is confirmed. The IRS can levy traditional IRAs, Roth IRAs, 401k plans, pensions, and other retirement accounts to satisfy tax debt. So what should you actually do if you are a senior homeowner and you owe or might owe IRS debt? The most important thing, the thing that legal and financial experts are saying loudly right now, is this. Do not ignore it. Do not pretend it isn't happening. The IRS collection process is designed to escalate, and every stage of escalation costs you more money and strips away more of your options. Here is what you can actually do. If you cannot pay your full tax bill by April 15th, you can file for an automatic 6-month extension using Form 4868. This extension gives you until October 15th, 2026 to file your return. But this is critical. An extension to file is not an extension to pay. Interest and the failure to pay penalty still start accruing on April 15th if you owe money and don't pay by that date. The extension only prevents the much steeper failure to file penalty. The Taxpayer Advocate Service, which is an independent organization within the IRS, has stated clearly that filing on time and paying as much as you can, even if it is not the full amount, significantly reduces the total cost of your tax debt and preserves more of your rights. If you genuinely cannot pay, the IRS offers payment plans, called installment agreements, that allow you to pay your debt over time. For balances under $50,000 in combined tax, penalties, and interest, you can often set up a payment plan online without even speaking to an IRS agent. Monthly payments can be arranged through direct debit. And as long as you stay current on the installment agreement, the IRS will generally not pursue wage levies or bank levies against you. If even a payment plan is beyond what you can afford right now, there is another option called currently not collectible status. If you can demonstrate to the IRS that you genuinely cannot pay your basic living expenses and also pay your tax debt at the same time, the IRS may temporarily suspend collection activity. Important caveat, interest and penalties continue to accrue during this period. The IRS may still file a notice of federal tax lien, but it stops the most aggressive enforcement actions while you work to stabilize your financial situation. There is also a program called Offer in Compromise, which allows certain qualifying taxpayers to settle their tax debt for less than the full amount owed. The IRS decides whether to accept an offer in compromise based on your ability to pay, your income, your expenses, and the equity in your assets. For seniors with limited income and a home that represents their primary equity, this can sometimes be a viable path, but the process is complex and approval is not guaranteed. And for seniors who are genuinely in crisis, there is the Taxpayer Advocate Service. It is free, it is independent, and it exists specifically to help taxpayers who are experiencing financial hardship or who are struggling to resolve issues with the IRS through normal channels. You can find your local Taxpayer Advocate office through the IRS website, or you can call them directly. There is also free filing assistance available right now through two major programs: the VITA program, Volunteer Income Tax Assistance, and the AARP Foundation Tax Aid Program. Both offer free tax preparation help to seniors across the country. AARP Tax Aid alone has thousands of locations at libraries, community centers, banks, and senior centers nationwide. These services are free, they are staffed by trained volunteers, and they exist specifically to help older Americans navigate a tax code that has become genuinely complicated. Now let's be very clear about something, because misinformation around this topic is everywhere. The IRS is not in the business of making people homeless. Home seizures, particularly of primary residences, are genuinely rare events. They require federal court approval. They represent the absolute last resort after years of failed collection attempts. The IRS prefers money over real estate. Selling a house is complicated and expensive for the government too, but a federal tax lien against your home, that is not rare. That is routine. And even without a seizure, a lien can effectively trap your equity, prevent you from selling, make refinancing impossible, and follow you, and potentially your estate, for years. The difference between a lien and a seizure might seem like the difference between a problem and a catastrophe, but both are avoidable, both are preventable, and both start with the same thing: ignoring a tax debt until the IRS has no choice but to escalate. Here is the bottom line as we head into these final days before the April 15th deadline. If you are a senior homeowner in the United States in 2026, the tax landscape has changed. New deductions create new opportunities, but also new complexity. IRS enforcement is ramping up. Penalties are severe and they start immediately, and the legal mechanisms that allow the IRS to attach claims to your home, your bank accounts, and your retirement savings are very real. But so are the solutions: payment plans, installment agreements, currently not collectible status, offer in compromise, the Taxpayer Advocate Service, free filing help through VITA and AARP Tax Aid. The resources exist, the protections exist. But they only work if you use them. If you or someone you love is a senior homeowner dealing with IRS debt right now, even if it is a small amount, even if you think it is not serious yet, please do not wait. File your return. Pay what you can. Pick up the phone. Reach out for help. Because the cost of waiting always goes up, and the options available to you always go down. Your home represents a lifetime of work. Protect it.